From the opinion pages of the Wall Street Journal, this is Free Expression with Gerry Baker.
Hello and welcome to Free Expression from the opinion pages of the Wall Street Journal. I'm Gerry Baker, editor-at-large of the Journal. Thanks for joining us. Just a reminder again, if you're not already subscribing, to subscribe at Apple Podcasts, Spotify, or wherever you do your podcast listening. And do always leave us a nice review if you feel so inclined. This week, well, the big, beautiful bill is working its way through the ringer of the United States Congress. I think it's fair to say that outlook is uncertain. House, of course, passed the bill almost a couple of weeks ago, and now it is under consideration by the Senate. Of course, the Senate has its own plans too. A number of senators have made very clear that they're unhappy with various aspects of the bill. Most of the attention, I think it's fair to say, is focusing on the extent to which the bill, President Trump's plans and Republican plans, add to the already enormous U.S. fiscal deficit, which is about 6-7% of GDP, and of course in the process adding to the massive pile over time of US government debt, which currently stands at nearly $37 trillion, and that is going to rise sharply. The report from the Congressional Budget Office this week said that the bill would add an additional $2.5 trillion to the debt over the next 10 years. That's obviously in addition to the increase in the debt that's already implicit in the spending and taxation plan. So we are talking about going from a $36 trillion debt to in the region of maybe $60 trillion debt over the next 10 years. The big question, of course, is this sustainable? Is this manageable? Will the administrations and the Republicans in Congress tax plans stimulate growth, perhaps to help reduce that debt? And if it isn't sustainable, what do we do about it? What happens? What does it mean for the outlook for the U.S. economy? Countries in the past that have faced debt crises of debts of this level have often slumped into crisis. Bond yields often rising very sharply. Governments forced to make dramatic changes or to inflate their way out of their problem. None of that is in the immediate offing for the United States. I think it's fair to say bond markets have, registered maybe a little bit of concern, although bond yields still remain relatively low compared to where they've been in previous periods when we've talked about fiscal problems. So there's no immediate sense of a crisis, but I don't think anybody really disputes that we are looking at a structural fiscal problem for the United States, which at some point is going to have to be dealt with, and it doesn't look like it's going to be dealt with in the coming weeks. Well, so to talk about all this week, I'm really delighted to say I'm joined by one of the world's leading investors, but also commentators on markets and economics, and of course these issues in particular. That's Ray Dalio. Very familiar name. You'll all know him. He founded Bridgewater about 50 years ago. It's become the largest hedge fund in the world. It has been one of the most influential forces in financial markets over that time. And Ray himself, of course, as I say, has been not just a highly successful investor, but of course the pioneer of certain managing and investing styles that have attracted a lot of attention too, and certainly attracted a significant number of emulators. I read a book called Principles, which lays out his ideas and philosophy about corporate management and investment a few years ago. Well, he's got a new book on this particular topic of fiscal challenges, of the fiscal crisis. The book is called How Countries Go Broke, The Big Cycle. And in it, he lays out from studies of fiscal challenges that other countries have faced, the mechanism by which a large fiscal deficit over time can create a major crisis. And he's going to go through that with me now and talk about the implications of it, and most importantly, perhaps, how we can get ourselves out of it. And Ray Dalio joins me now. Ray, thanks very much for joining Free Expression.
It's a pleasure.
Now, you have been warning about the broad sort of political economic crises that the West has faced. You've been writing and talking about this, Ray, for a long time. You're out now with this new book, which of course I talked about in the introduction, a new and important book about the particular how countries go broke, the fiscal challenges that we face. And as I said in my introduction, this is coming out at a particularly interesting time. Congress is considering this so-called big, beautiful bill President Trump wants them to pass. The House has already passed it. The Senate is considering it right now. It does add, depending on who you want to listen to, anywhere between $2 and $3 trillion to the debt that we already have.
That's long, by the way, but go ahead.
But we're talking about, we've already got a debt of $37 trillion, about 120% of GDP. It'll add more to it. So we have, however, been in this process of adding to our debt with these big deficits for a very, very, very long time. Why can't we just go on doing it as we have for at least the last 20 years?
I'm so glad you asked that question, because that's what I felt compelled to explain so that we understand the mechanics behind it. Okay, very simply, let's take a look at the numbers. Imagine that you're running the country like running a business or running your family finances, because the situation with debt is the same for a government as it is for an individual, except that they can print the money or they can take your money by taxes. So the economics is the same. What does that economics look like? Just running it through. They're spending $7 trillion a year. They're bringing in $5 trillion. So they're increasing the debt by $2 trillion a year. When you hear, by the way, that they said it's $2.5 trillion over the next 10 years, they're comparing it to what they previously would have brought in, okay? Not the actual amount.
Right.
So the actual amount will go from about 36 trillion to nearly 60 trillion over that 10-year period, just to put that in perspective. So now imagine, okay, you inherit this business and, okay, you're spending 7 trillion, you have 5 trillion that's coming in, and you can't significantly cut your costs because they're in things you can't really cut without breaking promises that are not breakable, Social Security or whatever, the interest payments on the debt. Now, that debt is the existing debt is about 6 times your revenue. And the interest rate on that debt is about $1 trillion, which is about 20% of what you're taking in and growing fast, and about 50% of your deficit. Okay, so that's the interest payment.
Yep.
You're now running this company, and you also have to pay back the debt. There's a certain amount of debt that matures. There's $9 trillion that matures. So with interest and principal that you have to pay back, it's $10 trillion that you have to come back of, which is twice more than you're taking in revenue. Okay, so that's your situation. Okay. Yep. So what happens mechanically, what I want to convey, is why mechanically is this time different in a sense? Because I've heard people say that, listen, we've been getting along and why can't we do it? Just like you asked that question.
Yeah.
Okay, it's mechanics. So let me say there are 3 things. First, the more debt that you accumulate, the more debt service squeezes out consumption. So what we can see right now, how it is squeezing it out consumption. And we could look forward and see how it will continue. You take on more debt, you have more interest payments, you have more principal payments. So it's going to take on more, squeeze out more. Well, what is there to squeeze out? We're very close to the edge of not being able to squeeze out. What, are we going to squeeze out defense spending? What are we going to squeeze out? There's a second problem that always happens. Okay, that is symptomatic of how countries go broke. And that is the supply and demand problem. What I mean is we're going to have to roll over a certain amount of debt. That's the 10 trillion that we have in there. And we're then going to have to sell new debt, which is the other 2 trillion that's coming due. And the question is, what is the size of the demand that wants to buy that debt? Okay, that demand is not increasing at the pace of the supply. The world has a lot of bonds that it's holding, including foreigners holding a lot of these bonds. And in the geopolitical environment that we're in, and given the other things, there's not an appetite that matches the supply. And then if you go worse than that, worse than there's this new supply that has to be sold, is if they don't believe in the debt as a storehold of wealth, they might sell bonds. So the quantity sold is not just the new quantity that's being produced. You could see the bonds being sold. So what you start to see in the market action, you're starting to see in that market action certain days in which the bond market goes down, led by longer interest rates. The dollar goes down and gold goes up. Okay, that's that kind of market. So I hope that paints the picture of the mechanics. We are at the spot where the debt compounds on itself, not only for the federal government, but for the central banks, because the central banks own the debt too. And so it's going to produce losses. And so where do you get your money from? You get your money from borrowing, from creating new credit. So you have this part of the cycle where you have to borrow money and print money in order to pay debt. And that's where we are at this inflection point. And it's worse than that, too. One more thing. And that one more thing is, if it's not dealt with during good times and it's dealt with in a recession, it'll be so much worse. It'll be so much worse because, first of all, recessions make debt increase more because of the cyclical component. And think about how we're going to be with each other politically if we have an element of a debt situation like I'm describing at the same time as we have this internal conflict, political and social conflict going on, a recession and a debt problem. It would be terrible.
So let me be clear. You're saying that there is, and again, you're not citing a number. I know it's hard to cite a precise number, but we are at an inflection point where essentially the cost of servicing the debt is eating so much of government revenue and the budget that there is some kind of a point where, if you like, it's almost a kind of a vicious circle where the cost of servicing the debt is so great and the deficit expands and the debt piles up to such a level that it's not sustainable. Again, I don't want to get too much into the weeds of the numbers, but I've been looking at some of the data today. You know, back in 2010, when people were warning about it, that's when the middle of the Eurozone fiscal crisis, the Greek debt crisis, US federal debt was then $13 trillion in 2010. That was about 90% of GDP. And people back then were saying, this is unsustainably high. I remember a book by Ken Rogoff and Carmen Reinhardt saying that there was kind of a level of around 100% of GDP, that sort of figure, where debt did become unsustainable. It certainly looked that way in Greece at the time, in Europe. Our debt then, as I say, just to repeat, was 13 trillion, about 90% of GDP. In that 15 years since then, Ray, we've gone from 13 to 36 trillion, from about 90% of GDP to about 125% of GDP. And yet we haven't so far seen, interest rates have been relatively benign. I know, obviously, interest rates have gone up in the last couple of years. That's partly to do with inflation, other things. We haven't seen the kind of alarm in the bond market that you might expect to see, that you certainly did see, in Europe with the Eurozone back in 2010. So are you saying we're not yet at that point where the markets will tell us that this is not actually sustainable?
It's so interesting. Using the same process, I anticipated the 2008 financial crisis, I think, as you know, and I anticipated the 2010 to 15 European debt crisis, as you know. And before all of those, when I walked into leaders who ran policy, they asked the same question. Okay. And the issue is they wait for the debt. They don't understand the mechanics of it. That's why I felt compelled to write this book, to convey the mechanics of it. And you can't wait for feeling the crisis. The reason it's different is this mechanism that I'm trying to, the numbers. How much are you squeezing out spending? How much are you left with no room and it'll unacceptably squeeze out spending? What is the supply like relative to the demand? Okay. So the reason I was able to anticipate those is because of those kinds of calculations, because of that. So that's why what I'm hoping to do is have thoughtful people take a look at that. By the way, in relation to GDP, throw out GDP. It's a bad number, meaning don't measure debt in relation to GDP. That's national production. Okay, it's not even profits, it's not cash flow, and it's for the nation as a whole. You have to measure it relative to the government's income and expenses. Okay, so that's why rather than say it's 100% of GDP, what I'm saying is it's 600% of revenue. Okay, so just like a company, GDP is not going to matter to the company. It's going to be its own revenue. So I encourage people to look at it that way and calculate, and you can see it. If you plot it on charts, you can see how much squeezing is going on and how much is left and what will exist next year, the year after, and so on. And you can see the new supply relative to the demand. You can make those estimates. And it is very different, as you might imagine. When you talk about 13 trillion, and now we're talking about 36 trillion today, and we're talking about in 10 years, 60 trillion, and you look at it relative to revenue and so on, you can understand the differences.
What do you say to those who say, look, they accept the broad parameters of your analysis, but say, and this is obviously relevant to this debate we're having right now about the budget and the tax plan going through Congress, who say the old kind of economic supply-siders argument, the kind of Laffer curve argument that says, yeah, but if we generate more growth in the US economy, this is going to be taken care of. Obviously, that all these people who are estimating these debt levels are underestimating the dynamic effects of cutting taxes, of regenerating the economy, boosting domestic energy production, all of that instead of 2.5% growth the US has been having for the last 10 years, a big supply-side revolution is going to generate dramatically higher growth, 3-4% growth maybe. AI is maybe helping there too, all of these things. And that will generate sufficient income. Obviously, the government's revenue will increase, and all of these fears about this explosion of debt will go away. What do you say to that sort of supply-side argument that actually we're putting in place the right policies to generate the kind of dynamic growth that will actually help us deal with the fiscal problem?
I have conversations like this, and I'm often asked the question. I should say that both Republicans and Democrats, when I go to Washington, agree with my analysis of the situation. So I think we can say that's basically the picture. That's at least an accomplishment. Now what we are dealing with is the question of, will the growth that if you borrow a lot and you create a lot of credit, will it create a lot more income than the debt that it'll create in debt and debt service payments? That's a way of asking. And there's a theory that it will create a lot more. By my analysis, that's not likely to happen. Of course, stimulation creates income. The way the budget deficit was reduced by 5% of GDP between 1991 and 1998 was through three ways, which I call my 3% three-part solution. The 3% means get the deficit down to 3% of GDP from about 7%, where it's likely to be. If growth is better than expected, it'll be somewhat less than that. And if it's not, it'll be that. Most estimates, unbiased estimates, will say 7 trillion. Okay. But anyway, get it down to 3% of GDP. And if you take it by a little bit from a number of things, you get there. You can do this with financial health, which means a little bit of spending cuts, about 4% of spending cuts, if you can cut spending by about 4%. If you can raise tax revenue by, not necessarily tax rates, by about 4%, then that goes a long way to improving the deficit. But it also improving the deficit. It improves the supply-demand picture, which reduces interest rates. Because the third influence on the deficit is the size of the interest rate. Because interest payments count for so much. They're such a big expense. And if you do that fundamentally in a sound way, you will bring down the GDP as, let's say from that 7% to about that 3%. And you will, in lowering interest rates, it is true that will help asset prices and will help the economy because credit will be cheaper, but it will do it in a healthy way. If you just do any one of these and you force it in a not healthy way, like you force the interest rate lower, it'll have a bad effect. Like you can force the interest rate lower. The Federal Reserve can come in there and force interest rates lower and buy bonds and do all of that. But the problem that does is that doesn't create the cut in spending. And it means for holders of the debt assets, it's worse, not better. In other words, one man's debts are another man's assets. And if you have an unnaturally low interest rate, it's undesirable to hold those assets and it moves elsewhere. The dollar depreciates and you're also bringing in more inflation. So my point is right now we can be in a position of take a little bit from those three places, in a sense, spread it out and get to that 3%, dealing well with those three parts.
I'm really interested in this period, 1991 to 98, which you talk about in the book and you've talked about there. And you're obviously absolutely right. That is the last period in our history when we went from fears of a major fiscal crisis to actually fiscal stability in a short period of time through exactly the measures that you talk about there and that you talk about in the book. So I want to talk about that. So we can all remember, 1991, George H.W. Bush having to, reneging on his promise not to raise taxes. The whole 1992 election with Ross Perot talking about the deficit and how much of a crisis it was creating. We get to the end of the decade of the 1990s where we literally have a government surplus, right? So those measures that you say exactly on the three things that were done, there were some tax increases, there were some cuts in spending, and of course, interest rates came down. But there were some important differences, weren't there, Ray? I mean, first of all, well, in no particular order, you had a peace dividend at the end of the Cold War. So our defense spending obligations actually declined quite significantly in a short period of time. That's obviously not the situation today. We had a really steep decline in inflation from, again, in the high single digits at the early part of the decade. Thanks to sort of fairly aggressive Fed policy in the early and mid part of the decade, we were down to like 3% inflation by the end of that period. And I'm just wondering whether that example is as useful as you say it is, because we now face, continued concern about inflation. We've got high interest rates to deal with that inflation, which may not have gone away yet. We haven't got a peace dividend. We've got the opposite. And arguably the political circumstances are different too, with no party apparently committed to cutting the deficit. Is it really the instructive example that you say it is, that period, or are we really in such a different economic and political climate today that we may not just be able to do that?
In the book, on page 343 of the book, I show many cases all around the world of this happening where the cut in the budget deficit is greater than 4% of GDP. And they all happened in exactly the same way. And it's important, therefore, that we look at the mechanics. The fiscal constraint is a negative on growth, but the lowering of interest rates, which also reduces the deficit, is a stimulative on growth. And they negate each other. It's what I call a beautiful deleveraging. In other words, there are two ways you can bring down your debt to income, okay? You can do fiscal, in other words, cut spending, raise taxes, which is more negative. Again, I'm saying spread it out how you do it, and that'll lower your debt. But you can print money and make it easier to pay your debt back with depreciated money, but that's inflationary. And when you do those things in an offsetting, balanced way, it has the effect of both of them bringing it down without having a significant negative effect on the economy or inflation. That's what I'm asserting.
Yeah.
And I show many cases around the world for that, doing that. The peace dividend means, yes, that you can cut some expenses and so on. But if you look at the attribution of what actually happened there, it wasn't very much the peace dividend or anything like that. It was that balance was achieved in those ways. And in the numerous other cases that I show in the book, it's that balance. So the question for analysis, look, I'm just providing the analysis. It's up for others to decide. Does that make sense? Is it logical? What is the evidence? So that's why I'm laying it out the way I am for others to decide.
We'll take a short break there. When we come back, I'll have more with Ray Dalio, founder of Bridgewater and author of How Countries Go Broke, The Big Cycle. We're talking more about the debt problems, the debt crisis that the US may face. But we'll also talk about the wider geopolitical and political context in which we're operating and the risks that we may be sliding into a much wider political and geopolitical crisis that goes well beyond just the economics. So stay with us.
You're listening to Free Expression with Gerry Baker. Don't forget, you can listen to the latest episode anytime on your smart speaker. Just say, play the Opinion Free Expression podcast. Now, back to Gerry Baker.
I'm back with Ray Dalio, founder of Bridgewater, the world's largest hedge fund. We're talking about his new book, How Countries Go Broke, The Big Cycle. If we do continue on the current path, and again, I'm not asking you to give me a time here or a date. One economist famously said always forecast the number or the date, but never both. We have seen some bond activity in the last couple of months. It's all complicated. I mean, people didn't like the tariffs and, they were concerned about the economy. Bond yields went up. Bond yields came down again when the tariffs went away. They went up again a little bit. Moody's did its downgrade of government debt. We had the big, beautiful bill. There are different some people argue, bond yields are moving, nothing to do with fears about the fiscal position. But let's just assume that bond markets do start to demonstrate some real real concern about the fiscal position, as they have done in the past, or as they did famously in the UK in 2022 when Liz Truss with her infamous budget came out, bond yields went through the roof and essentially killed that plan. And Jamie Dimon has talked about this just in the last week, Ray. If nothing is done, and if we continue on this trend and we don't do your 3% solution or any other kind of a solution, how will we know when we've hit the buffers, as it were? Will it be a real significant bond market reaction? Is that what you'd expect?
Yeah, what I would expect is a stagflationary kind of, almost somewhat similar to 1970s kind of trade-off. The dollar was devalued in 1971. We had a commitment to pay in gold, and gold was money then. Paper money, as we know it, was just claims on the gold, and they were running out of that. And so then what happened is there was a devaluation of money, breaking that off, and we had the 1970s stagflation period. So you have a negative on economic activity and a rise in inflation, and you'll have some mix of those things, and the central bank will be trying to balance those things. So if you have the downturn, then there'll be much more stimulative and so on, and then rates might fall, but you have accelerated inflation. You have a difficult trade-off for the Federal Reserve, for the central bank to make, particularly because central bank will be losing money. It'll be a difficult situation. I would say is that what should happen, I think, because there's this agreement of what I'm saying and three-part solution down there, it's like being on a boat that is headed to the rocks. And the people on the boat are Democrats and Republicans, and each have an ideology. And you have to say, well, we have to turn. I don't know if it's a little bit left or a little right, but you have to turn if you're going to move the rock, not hit the rocks. We're in that kind of a situation. Now, I can't tell you what exactly will happen in the form of what the budget will be. Most likely, this will not be resolved and we'll be heading to the rocks. It's most likely that this will not be taken up seriously until after the midterm elections. And then the only way to do it, in my opinion, is a bipartisan commission that deals with this must happen. But the problem is that that's going to be probably 2 years from now, and you're going to have the compounding, and there's big risks in that 2-year period. I think that that's what's most likely. Then you're going to see more pressure, very much like what happened in the war years or the post-war years for Britain, let's say. For example, there was the period where after post-war, Great Britain demanded its colonies to buy its bonds and not sell its bonds. So we will see probably extraordinary measures taken to discourage or prevent or tax or something to prevent the selling of bonds and those kinds of things. Now, what happens exactly, I cannot tell you, but I do think we have a very, very serious, because if you give us another 2 years to start figuring out what we're going to do and that we handcuff each other together where we must make a solution, I think every person in Congress should take responsibility. If we hit the rocks because you don't have 3% target, the way I'm describing, that they say, I am responsible for that, and that I shouldn't be in my job. They should be fired from their jobs if we have the type of situation that I'm describing.
Well, this is the classic problem with deficits, which is that you don't get elected by promising to raise taxes and cut spending. You get elected by promising to cut taxes and raise spending, right? And until some exogenous or some market event happens to concentrate minds, that's all the direction of political incentive.
This has happened for as long as there's recorded history.
Right.
That Plato wrote about it in the Republic, that democracies end because of the demands of people and politicians to give them those things. And it creates problems that then create disorder, that then create internal fights. So when we see the internal fights, which are between the left and the right and people of different values, you're seeing a desire for somebody to take control of this and make it go right.
Right.
And the promising, I will take control and I will make it go well, becomes the path. And so compromise, like political compromise between parties, is not viewed as strength.
Yeah.
And it becomes a problem. So you have a political problem. You have not only a domestic political problem, you also have a geopolitical problem going on at the same time. The world order is changing.
Yeah.
How countries are with each other are changing. There's greater conflict. That's what the picture looks like.
I want to talk very briefly about that right at the end, but just one final quick question on this, how countries go broke. And you've mentioned this already a couple of times, and I want to flesh it out a bit. One way in which countries that face a debt crisis often deal with it, attempt to deal with, that you can default on your debt. Obviously, some countries have tried that, didn't work out very well, a country like Argentina, for example. But there's another way of defaulting on your debt, in effect, which is to inflate your way out of the debt, right? You have sort of massive inflation, hyperinflation that actually obviously reduces the real value of the debt, enables you, to be able to pay the debt. We've seen that in many countries over the years. Again, that doesn't always end well. But I mean, again, short of outright default, which I think probably most people still think is very unlikely for the US, but a kind of an inflationary effective default. How do you rate the probability of that? That's much more likely, isn't it?
Yes, I would say 10 to 1 that it's going to be that.
Yeah. And then we see all the costs of that from hyperinflation in the past, all the separate costs that have. Since you raised it, and I'm really glad you did, because you've also written really interestingly, Ray, over the last few years about the geopolitics that we're in. And you mentioned this in the book too. Of course, you talk about it a little bit in the book, but the circumstances we're in, you've compared in some respects a lot of what the circumstances were in to the 1930s. You've written extensively about that. And of course, we all know how the 1930s ended. You look at the geopolitical tension between the United States and China. You've spent a lot of time in China. You know the Chinese, that relationship extremely well. You've looked at the state of our own democracy and the health of our own democracy and politics. Now, I don't want to leave our listeners on an overly gloomy note. So let me put this in two parts to you. One, the sort of the gloomy side, which is how bad is it and how like the 1930s or some of these other periods that you've studied of grave political and geopolitical crisis? What are the similarities with that? And maybe the more positive note on which to end, what lessons do we learn from those experiences so that we can actually avoid the consequences that occurred on those previous occasions?
In my 50 plus years of being an investment manager, I learned about these mechanics, and then I studied the last 500 years. So my prior book, as you know, is The Changing World Order, and it studied the patterns of the last 500 years and the logic.
Yeah.
And then I've gone back more, and I see this same pattern happen over and over again. And there are changes in orders. Everybody should realize that all monetary orders have broken down. All domestic political orders meaning systems, have broken down. All geopolitical world orders have broken down with great conflicts and so on for certain reasons that happen over and over again. And there are 5 major forces that drive these cycles. The first is the debt, money, credit economy force that we've been talking about. The second is the internal order and disorder force, in which then there become irreconcilable differences between the left and the right and different values that cannot be compromised. The third is geopolitical order internationally, the rising power challenging the existing power and a conflict, because there's no world court that you resolve things with. It's resolved by who's got the power and their tests of power. All 3 of those things are interrelated. So let's say if you have more defense spending, more military spending, it affects the budget. And if you don't have the budget, you don't have this. And then number 4 force always has been acts of nature. Droughts, floods, and pandemics have killed more people than wars and toppled more orders. And number 5 is man's inventiveness and new technologies. Okay. Yeah. All of those 5 are very disruptive. The last one can work out terrifically well in many ways, but you still have to have people together how to bring about order. The first 4 are disruptive. If I take the debt one, if I take the internal political one, if I take the international geopolitical order, if I take climate and nature, these are all in worsening trends. If I take AI and technology, it may end up being terrific in many ways, but it also, that AI and tech can be used for war, can be used badly. So we have a situation that's like that. So when I look at this, that's how I view the future. There's a lot of uncertainty. So to answer your question, it all comes down to how people are with each other. In other words, can you compromise rather than hurt each other? Democracy requires compromise. Can you do what's good for most people in the society? And how we're going to do that? So even if we have technology making wonderful productivity, question, will it produce the income that is necessary to overcome all of this? The likelihood of a major improvement in the same time frame, even though I'm very bullish on the technology, is limited, but it can also be, it comes down to how people are with each other. So that's human nature has brought about these cycles for a long time. Okay, what is the punchline here? What did we do? I have a principle, which is if you worry, you don't have to worry. And if you don't worry, you need to worry. Because if you worry, then you'll take care of the thing you're worrying about.
Yeah.
We have the capacity right now to work well together, to deal with these situations. Okay? If we worry, if we don't worry, we are going to have real problems.
Yep, that's very neatly put. The temptations and danger of complacency is another way to think about it. Well, we're certainly worried right now. Ray, you're probably going to worry us even more rightly with this book, but your new book, How Countries Go Broke, The Big Cycle. Ray Dalio, thanks very much indeed for joining Free Expression.
Thank you for having me.
Well, that's it for this week's episode of Free Expression. Thank you again for joining me. Look forward to speaking to you again next week. In the meantime, have a great week and goodbye.